So it's now the middle of March, and we started 2023 coming off this ice cold fourth quarter, third and fourth quarter last year. Home buyers had stopped cold. The inventory started building. We can see price reductions. The whole market froze solid after the pandemic boom. And every week since the 1st of January has been a real surprise to me. And it's really a surprise about why that second half of last year, why that trend didn't appear to continue. Why did it seem like consumers stopped cold with 6.5%, 7% mortgage rates? And now this spring, it feels like a different story. When we watched inventory climb last year, now after the first of the year, we're watching inventory fall each week. Why are those things happening? And really, what happens next? So we have some data. We already know what's happening for a lot of the year, a lot of the leading indicators that are already in the data. We can already see what's happening for the rest of the first quarter, into the second quarter, the sales that'll close, and really what that means for all of 2023. So that's what we're going to look at today, what we know already in the data right now. And of course, we like to talk about how to frame the data for our discussions with buyers and sellers, with market participants who really need to understand what's happening in the market right now. Before we dive in, as usual, we have Jeff and Lael from the Altos team who are in the chat. We have folks, hundreds and hundreds of folks on the call today. And if you have you have questions while I'm going through the presentation today, you can use the chat to ask those. Jeff and Lael will be in the chat to try to answer things on the fly. Also, if I share links or references, they will be in the chat to share those links so you can click through. You don't have to write stuff down. As always, these webinars are recorded. So if you registered and signed up, you will get the recording later on. You'll get an email from us later on today. Look for that as a follow-up that has the links to the recording so you can go back and use it over time. Altos Research, of course, tracks every home for sale in the country once a week, and we bubble up those analytics, the pricing and the inventory and the changes in that data, and we make it available to you before you see it in the traditional channels. And so, we watch the video, we watch the data every week, and you may watch our videos weekly. But what we're going to do here is take the hour to look more detailed than we can do in 10 minutes of weekly video. We're going to try to look at not just the inventory number, but why the inventory is where it is and where it may be going for the rest of the year, the shrinking supply story. Are we ever going to get inventory again? We have really significant moves in mortgage rates. They were starting to come down. Economic news was strong. Mortgage rates went back up. Now we have bank runs. And so the risks in the economy, all of a sudden rates start falling again. These are all things that we're dealing with and that our consumers are dealing with every day. So we'll try to share a little bit about that. There's a lot of data in home prices, and there's a lot of headlines about home prices. So a lot of what we're doing is having a conversation with buyers and sellers about what they should know about where home prices are right now, where they are likely heading in the future. And then, of course, we're going to try to spend as much time as we can in the local markets because there are some behaving very differently. There are some trends that have changed since last fall. So if you had impressions about what was going on in certain markets last fall, some of those markets are different now. And so we're going to try to spend a lot of time there as well. As always, use the chat. Lael and Jeff from the Altos team are in the chat. They have links and they can answer questions on the fly and will be recorded. So before we dive in, everything that I talk about today is that I'm using the Altos data. The Altos data is available to you, that you can get branded for you and your business to get into your hands, to the hands of your buyers and sellers, everybody who needs to know from you how your local market is behaving. And one of the resources we've created is a free ebook for you to be able to talk about the data. And we've built in scripts, and we've talked about ideas and how to use the data, how to share the data, how to answer some of those questions. So if you don't already have the Altos ebook, How to Use Market Data in Your Business, go to the link that is in the chat now that will be shared in the chat. Lael and Jeff will share that in the chat. You can click through, download that ebook to use it. So all of the stuff I'm talking about today is baked into the Altos data. You can use that in your business, and so that's what the ebook is for. So make sure you go grab that. All right, let's start diving into some data. I like to start the webinars with mortgage rates because mortgage rates are the big metric here. We have in the broader economic data, when rates are at 7%, we have notable affordability challenges for buyers and sellers. It is hard to make the payments. It is significantly harder to make the payments on those homes than it was just 1 year ago. And it's not something we should ignore. What's been fascinating is that, so in this chart here, we have a decade of mortgage rates, and each color is a year, and you can see the bright red on the right end of the chart here. That's this year. And so rates have, with strong economic news, rates have surged up around 7%. They dropped down a little bit this week, but what's been fascinating is there are buyers in this market who are buying and able to afford their payments at 7%. And I think a couple of things are happening here. One is that when we think about affordability, we think about affordability for millions of homes, because traditionally you might have 1 million single-family homes on the market now. Now, currently, there's only 400,000 single-family homes on the market. So payments have to be affordable to a lot fewer people. And so there are still people who are able to make those, afford those. And the other thing and so those are the folks who are buying right now. And I think the other thing that's happening is you probably have buyers who see this curve and they assume that mortgage rates will fall again in a year or two and come back down. And at that moment, they can refinance to a lower rate to lock in. So I think we have both those dynamics happening. I think it's really interesting to note that the mortgages that are being done now, as opposed to like the bubble in 2007 and 8, the mortgages that were being done in 2006 and 7, those were being done with unaffordable payments really after a couple months, a teaser rate of a few months that was 2%, and then it was going to reset up to a higher number, and then those buyers got in trouble. In this case, we have buyers that are buying at the high end of their affordability range with the assumption that they're going to refinance down in the future. And so these are buyers with some expectations about the future, which may or may not come true, but it is a stronger position than we were in 2006 and 7. And it's really notable because a lot of folks out there, rightly so, are worried about a housing bubble. They're worried about home prices tanking from here. They're worried about buying at the peak. And all of these fears they're real. And so we're trying to share with the data how you might think about it, how you might as a buyer or seller make decisions about how to act right now. What we know right now is that in the fall, there was this 5.5%. When rates were above that, there was significantly slower activity. When they fell below, we could see buyers really picking up. And I think that's a reasonable rule of thumb to think about. We'll have affordability threshold that feels like it's about 5.5%. And the closer rates get down there, the more activity you're going to see from buyers able to go jump into the market. And the question is how we get there. We had bank runs over the weekend, and when there's panic in the financial markets, one of the things that happens is the expectations of mortgage rates and interest rates are going to come down. And what promptly happened was mortgage rates went from about 7% to 6.5% since last week as a result of financial scare. Now, financial scare is not a good, it's also a thing that will hold back buyers. So we have all of these risks. There are a lot of risks in the economy and reasons that might derail the current trends in housing, things to keep in mind. The other thing that could happen is the economy continues to be very strong and rates go above 7%. What if they go to 8%? The affordability challenge will change again. So let's look at what we can see in the data. As of this week, there are 412,000 single-family homes available unsold on the market. That's been falling pretty dramatically each week since the beginning of the year, and since actually in the fall. And normally by mid-March, inventory would be climbing each week, climbing by 1% or 0.5%, and then starting to really climb in April and May. And you can see each year's curve. And what we have as of this week is we haven't found the bottom yet. And we'll have 1 or 2 more weeks of declining inventory probably before inventory starts to climb again. And so normally inventory bottoms in January. And my expectation was that because we had such a slow market in the fall, that inventory would start climbing pretty quickly, right? We'd had few demand, so therefore supply would start to build up. And we've been surprised with fewer homes for sale each week through right now. You probably have buyers and sellers in your market, in your sphere, who assume that the market is tanking. They're familiar with headlines from last fall, and they assume that sellers are panicking, and they assume that inventory must be climbing. And as of right now, none of those are basically true. And it's a really important distinction for somebody who's trying to make a decision about whether to act right now. I have a friend who is buying in Hood River, Oregon, one of the classic Zoom towns, move out of San Francisco and work remote from the nature, in Hood River. And Hood River was a booming market. And my friend is interested in buying a home. As he was negotiating for one home, his dream home in Hood River became available. And it's an expensive home, but it had the views, it has all the things that he wants in Hood River. And he ended up in a bidding war with 3 other buyers and lost in the bidding war. It was okay for him, but it's a bidding war at a high-end home in a Zoom town. And there's a lot of the world who has no idea that this dynamic is happening. And you can really you can see it right now because there's few available for sale. The buyers who are interested and capable of affording and buying are taking action, and you can see it in the inventory numbers each week. And really, here's the way we can look at it. So this is the new inventory, new listings each week. Each bar here is the number of new listings each week. And the light portion of the bar are those that went into contract immediately. So we call these immediate sales. And during the pandemic, the last couple of years, the proportion of homes that got listed and then took offers and then went into contract within just a couple of days was a third, really a big number. And bidding wars and multiple offers, all of those scenarios. the tactic of using coming soon listings, like this home is going to come soon, it's going to list soon. And so then buyers know, and they're ready to make an offer the day it gets listed for sale. That tactic really exploded through the pandemic. What's fascinating right now is we have fewer new listings, right? Less supply, fewer sellers, 20% fewer than last year at this time. But we have more immediate sales this week. We can see a climbing number of immediate sales. So like my friend in Hood River, there's 29% of the homes that were getting listed are taking offers essentially immediately. And so this is a surprise compared to, you can see how the light portion of each bar shrank in the second half of last year, so that you can see the peaked on July 4th, and then the new supply fell off very dramatically. And each week we had fewer and fewer of those immediate sales. That light portion of the bar got smaller. Now it's growing again, and it's spring, right? So this is the time people buy homes, but it's also the time people list homes. And what we're seeing is there's no signal anywhere in the data of a surge of listings. There's hypotheses, and you'll hear people talk about their expectations of new inventory that should be coming. And the fears or those expectations are, investors that are panicking that they won't be able to get their rents. And so they're going to want to sell before the market tanks further, or distressed homeowners, people who lose their jobs and therefore can't make the mortgage payments, and they need to list and sell their homes. And what we see right now is that none of those hypotheses about where new inventory will come from, essentially none of those are happening now. The inventory is not there yet, but it's a real risk for the future, right? It's something that we obviously need to keep our eye on in the future to see if inventory spikes like it did last year. And last year we had some new listings, and we just had a real drop off in demand, and so inventory climbed very dramatically. So when you're talking with people and about their expectations of the housing market, they have news of what happened last fall, and they have expectations about what they think is going to happen in the future. And what we have right now is, here's what's actually happening right now. So if you want to buy that house, it turns out that we need to make an offer today, because a third of these, or 29% of these, are going into contract immediately. The good ones that are priced right are taking offers and going into contract immediately. And with my friend in Hood River, this was a rare house, a rare property that was very special. It was his dream home, and it was obviously the dream home of several other people. And so he ended up not getting that one, but it was a bidding war that's happening right now that would surprise a lot of casual observers in the housing market. So this is the new listings, and we can see that this week nicely, like in sales, new sellers starting to climb up, but significantly fewer than last year. And so then let's look at our forecast. How can we envision what might happen to inventory for the rest of the year? Each line in this chart is a year. So each curve in inventory starts low and starts climbing usually in January and February, and then peaks later in August, September, and then starts falling back down. So each line is a curve. The two bottom lines, that's the last 2 years. You can see the pandemic years in here, and the dotted line is where we are this year and what we might expect for the rest of the year. This forecast so currently estimates us at about 625,000 single family homes on the market at the end of the year. So more than where we ended last year, but still not back up to the pre-pandemic normal. This assumes that we still have more slowing to go, meaning economy slows, or we have some of those inventory sources that start coming. We have buyers that back off even further from here. And so that would assume that we get a steeper climb of inventory in April, May, June, July. You can see how the dotted line kind of slopes up pretty quickly. And But what's interesting is that every week so far this year, for the first 10 weeks of the year, every week, the model that we use has been over predicting what the actual number of inventory is. So each week, this number is being revised lower because we have fewer sellers, we have more buyers than we expected. And so if that trend continues and the market doesn't slow actually from here, we could finish the year at about 500,000 single family homes again. And it's wild to think about the fact that we'd be post-pandemic, we're in a new economic era, and we'd still in this world where we have half as many homes as we did 3 years ago. But those are the scenarios that we can see. So, you can still expect more, but it's really hard for me to see, absent some like dramatic economic change, like big spike in mortgage rates or big job losses. It's hard for us to see this number getting back to anywhere near normal this year. And so we should expect to be in a shortage of inventory, a shortage of homes for sale, for at least the next year. We can see that we obviously have more homes for sale now than we did a year ago. A year ago was crisis lows, but most of the country is still in these pandemic lows. And I'll show you some of the local markets where that changes. But that's really how to think about the forecast for the rest of the year. There's, even assuming that the market slows from here, there's still no signal anywhere in the data that we're going to get back to normal levels of inventory. And that's been revised down as the data keeps coming in lower. All right, let's talk about pricing. We can think of the Altos data with three leading indicators of home prices. There's the homes on the market now, the active pricing. That's the median price of all those homes right now is 428,000. If you walk into the market right now, that's exactly what you'll see for the price of homes. Interestingly, that's the red line here. So it goes up in the spring. New stuff gets listed, the best new stuff gets listed, and then it peaks June 30 and starts to ease back down. The slope on that dark red line is lower than last year. So last year, prices were increasing still very dramatically each week. This year, they're increasing at a lower pace. So the difference is growing each week. And in some of the cases, so for example, the median price of the homes that got listed this week, the cohort each week, the price of the new listings, that's actually lower than it was last year. $399,900 versus $399,999. So that's a tad lower than last year. But if you think about what I really like about the price of the new listings number is that it is what we call the wisdom of the crowds. It is every seller and listing agent in aggregate knows exactly where to price the home, where any given house may be over or underpriced. But in aggregate, they're very close to where the ultimate sale actually happens. And so what this tells us is that the sellers right now who are pricing just a fraction below nationally, just a fraction below the last year at this time, they realize that there's no upward pressure on pricing. There's no signal that prices are increasing from here. And it tells us that they know that there's a stability in this. So you can see the light red line is kind of going sideways at the right end. And so normally this time of year, that in a harder market, you can see how it goes up steeply as new listings like, oh, there were bidding wars. There's lots of offers. I'm going to price my next one a little bit higher. And so what this shows us is price stability in the data. What is going to be important to note, though, is that the headlines that use sales data, that use the Case-Shiller, those headlines they're going to be reporting negative for several more months. They're going to be headlines that be like, we'll see that the prices are ticking down each month and and the year over year comparison gets worse and worse because last year it was going up really quickly. And so what we can see is that that from here, there's really no further downward pressure on pricing, so that those in several months, those headlines are going to start to level out. But as of in the next few months, your buyers and sellers are going to be reading these headlines that say home prices are down. And they are, right? We saw this dramatic decline in the fall. And so like, it's not that information is not wrong. It's just old. And so we want to help people see that that's what's going on. And it's also important for us to know, like, we can see that you know, obviously last year we were coming out of the pandemic, and those prices, like, inventory was ultra low. We had people buying, trying to take advantage of the low rates at the last minute. And that demand was super high, and that was driving prices up. And then that stopped abruptly. And so we're going to have these year over year price changes that show down, and they show down for the whole year, down, flat to down for all of 2023. But they don't look, there's no signal in the data here that it's going to be down from here. I think that's really the important message, at least at this point, until something big changes, the current trends. And this is that price of new listings broken out by year by year. So you can see the dark red line is this year. And normally, you know, in a growth price year, the new listings are above the year before. We started 2019. In 2018, mortgage rates were rising and the market slowed. And so by 2019, the year over year, the light blue and the yellow, the blue and the yellow down at the bottom there, you can see how those years started at about the same price. And then 2020, in the pandemic, prices took off in the second half of the year. So you can really see it in the price of the new listings. The light red line, you can see how that compressed very dramatically all the second half of last year. And that's what the headlines are reporting now. So we can see that we're now, you know, even or just below last year. And in April, May, June, you can see how we probably will be in this trajectory below last year. And so there's several months of those headlines to still hear. And that's really what we can see in that price of new listings. Let's switch to the pendings. These are the homes that are in contract. And the total homes in contract at any given time, and each bar here is a week. The light portion of the bar here are the newly in contract. So we can see that there are significantly fewer homes in contract now. This tells us that these are the homes in contract now. It takes 30 or sometimes 45 or 60 days to close. So these are transactions that'll happen in March, April, May. And there are significantly fewer of them in contract now. So the headlines are going to be talking about how many fewer home sales there are. And one of the challenges is that in the media and as a consumer, it can be easy to try to judge the market by the total number of transactions. Fewer sales, that means fewer people want to buy homes. And in some ways that's true. On the other hand, we're in a supply constrained market. And if there were more homes for sale, there would be more transactions happening. And so you can't really judge demand by the total number of sales. All we can see is that we know that there are fewer in contract now because there was less demand last year. There are 22% fewer homes pending right now than there were last year, 323,000 single family homes. There are 64K new contracts this week. And so that's 13% fewer than last year. So that light portion of the bar is a little smaller than it was last year at this time. But last year at this time, remember, everybody's trying to get that last deal in at 4% before they can see mortgage rates going up higher. And so that was pulling a lot of those transactions forward into March and April of last year, like people trying to get in before the punch bowl got taken away. So total transaction count ticked down. But what this tells us is that the new contracts is still smaller than last year, but actually, you can see it growing each week. Again, these are signs of stability, not like explosive growth on the pendings. And here's another way to look at the pricing. So the price of those pendings is also just below. So these are the homes that are going into contract. We know that they are just below where they were last year at this time. And so just fractionally below. And you can see that in the next few months, where the light red line continues up, and the dark red line will probably have a less steep trajectory. So you can see April, May, June, July, those transactions we'll see a year-over-year price decline. But we can also see that it's not going to be like 60% or 25%. You can see the trajectory. It's going to be a little bit lower. So 0 to 5% home price decreases for the year. And what's fascinating is because so much of the activity in the housing market happens April, May, June, like that's how you can kind of forecast for the rest of the year where prices are going to be. And we can really see, so, nobody's making a decision right now about, hey, if I buy this house, I'm going to get equity this year and I'm going to sell it next year and make my money back. People, I think, don't have that expectation right now, but many of them are worried that I'm going to buy right now and that home prices drop 25%. And what we can see here is that there's no signal in the data yet of big price corrections. We can see that, yes, you're going to go in and you're going to hear these headlines of home price decline year over year, but there's no sign of things going the opposite direction. Like we can see the homes that are getting bought, we can see exactly where they're priced. And like that's a very valuable message for buyers and sellers right now. And so then the other side that we like to report here are price reductions. It's really fascinating. So like inventory, where inventory has been surprising me with fewer and fewer homes for sale each week, you can see we started the year with the dark red line there at 40% of the homes on the market with price reductions, significantly more than any recent year. But that is ticking down each week. And speaking of headlines, I was looking today, Redfin released a report today, and the report headline said the sales have record levels of price reductions and concessions. And what the sales data is, so these were sales in February. These were houses that were on the market in October and November, and they took price reductions back then. They got offers maybe in January, and now they're closing. And so what that Redfin report today is telling us that is showing us about how high this number was back here in November. Price reductions in November were at their record high, not record on our data, but at their peak. And so the headlines are, again, the lagging headlines are showing us that, yes, the stuff that was priced last fall did price reductions, and the stuff that's closing now has those price reductions. But the stuff that's on the market now for transactions that haven't happened yet, those price reductions are falling. That's because inventory is lower. It's because the new listings aren't overpricing, and it's because there are some buyers who are taking advantage. So supply is very low and there's some demand, and as a result, those price reductions are in a very normal range now. Again, if it's in addressing the fear of your buyers and sellers and addressing, like, how do we discuss actually what's happening when you just read this headline? This is one way to take a look at that. And what I like to do at this point is actually, I'm going to switch and do some local view of price reductions in particular. This is the Altos platform, and I'll take a minute here. We have I'll show you what we've got here is in the Altos system. You're subscribed to your reports, your local reports for your market, every zip code in the country. and those are branded for you. And we can see how many people are opening them. And we then obviously send those to your contacts. So we're in a space now where people are afraid. People would like to transact, they'd like to buy or sell, but they're afraid of what's happening next, what's happening now. And so those folks need to know the data. And so you put their contacts in here and you get them a report every Monday and you say, here's actually what's happening in the data. And those campaigns are how we set that up. And I'll show you some of the reports when we do more local data in a moment. And by the way, from the Altos team, Jeff and Lael are in the chat. If you have questions about the Altos product, you want to book a demo, you want to go see it for your local market, connect with them. There'll be links in there on how to go do that. So you can go book time with the team and walk through. We don't have time to walk through the Altos product in detail here. But what I do have open is our advanced analytics platform. And I have a rank chart set up for ranking the top 50 metro markets by price reductions. And I've showed this on each of our webinars for the last few months. What it shows us right now is that Phoenix has the most price reductions of any big metro in the country. We can also see that Phoenix was at 60% with price reductions in the fall. That's really cold. That definitely tells us that future transactions are going to price lower. That number has fallen down a little bit into the 40s. The biggest change, interestingly, in this list over the last few months, if you've been paying attention, you would notice that we had, it used to be Austin and Phoenix and Boise and Salt Lake and Denver. The American West were topping the price reductions last fall. Right now, you'll notice here's Sarasota, Florida, Winter Haven, Florida, Ocala, Tampa, Orlando. The Florida markets have gone from further down this list and are recovering less quickly from last fall than the Western US markets. And I think that's a really notable change so Daytona has 39% with price reductions now. They were 40-something% last fall when Phoenix was at over 60. And so it's really interesting to see the Florida markets dominating the price reductions right now. That is a local shift that we hadn't seen before. And I'm going to come back and I'm going to dive into some more of the local data in a sec. I'm especially interested in showing more about Austin because I think there's a lot of really interesting things happening there right now. Okay, let's do a little bit more of this and then we'll get back to the local data. So days on market, median days on market is now falling for the spring. Last year, of course, it was like 1 month or less. Right now it's two months, twice that, but actually falling pretty rapidly and as it does this time of year. So, that implies a little bit of normalization. Days on market didn't get to anywhere close to where, was back in 2017. So like things are moving quicker. There's less that is still sitting around from a year ago or 2 years ago, the garbage that didn't move. Because that stuff is all cleared out of the market. So days of market is ticking down, and we'll look at a few of those in the local side. On the rental side, single family rents are still up from a year ago, but they're down from their peak. And so, but what we can see in the data is that there is no significant downward pressure from here on rents at the moment. And I think this is a function of the fact that Americans are still really well employed right now, even though there are fears of job losses coming, they're still actually well employed. And you can see that in the rental data. The frenzy is off. And things like the consumer price index, which uses rents, is still using that big bump is in the CPI numbers still. And that'll start meaning our inflation numbers will start coming down in the next few months finally. But you can see that trend over time and no real downward trend in rents. Again, as I mentioned when we started, all of the data we're talking about here is in the Altos reports and in your Altos subscription for your local markets, zip code, every zip, city, county, metro in the country. And you can get that free ebook to learn how to talk about the data. And so if I'm rushing through things or if you have questions about how to do it, go get that. There's a link in the chat that Lael and Jeff will share that you can go click through and get that ebook. All right, let's go back and do some local markets, shall we? Let's see here. So let's start with Austin, Texas. Austin is one of the very few markets that has inventory greater than it was in 2019. So pre-pandemic, and this is in the inventory chart for the Austin metro market. And we have, here's where inventory is now, 6,500 single family homes. A year ago, 1,400. So this feels very significant to anybody who's in Austin. But, you know, here's 2019. So we're back to 2019 levels in Austin. And it's one of the very few places in the country where that is true. Most of the country, and I'll show you in some of these other local markets, have inventory just a little bit higher than last year at this time. And that's really, I think, a testament to, you know, Austin had big inbound immigration, a lot from California, who were able to bid and overbid on homes when rates are at 3%. If you overbid by $100,000, your payment doesn't change very much. But at 7%, your payment changes a lot. And so those types of bidders stop very quickly. And you can see how dramatically inventory climbed last year when those bidders stopped doing that. So we have that current level of inventory in Austin, and it's ticking up for the year after the beginning of January. And so that is a notable thing. We can also see that the price reductions, the percentage of homes with price reductions in Austin, are still significantly higher than normal for Austin. It's definitely higher, more price reductions than during the pandemic. But even here in you know, this range in the pre-pandemic times, 2018, 2019, you can see that, you know, 2019 is only 30% of homes with price reductions. Now there's 46. So there is still a lot of adjustment to happen to prices in Austin. And you can see a couple other places that I'll show you, but much of the country, that's not the case. And it's a really fascinating a situation. And I think it's really a direct, like Austin had so much of the Austin market was driven by inbound immigration from places like California, and that had to stop very cold. So let's look at Phoenix. So Phoenix is the other place that is, you know, a dramatic, it's a big investor market. It's a big iBuyer market. And those things stopped very cold, very quickly. And so this is price reductions in Phoenix. Phoenix still has the most price reductions of anywhere in the country right now. And at 48%, this still implies that there's future price, the transaction prices still have to come down, because there's still essentially half of the stock is taking a price cut. And so that implies that there's still more sensitivity that hasn't come out of the Phoenix market yet. So, you know, we talk about price stability nationally, we can show prices increasing, but you can see in places like Phoenix still probably has some of that to work through. And you can see over time, this is 5 years of data, you can see normally might be 40% of the homes take a price cut, and right now we're 48. And it's also probably starting to tick up in the second half. So the new stuff that got listed, if it didn't get an offer yet in March, it does a price cut in April. And so there's definitely those to see in Phoenix. But if we look at the inventory levels, you know, Phoenix inventory levels is not nearly where it was in 2019, right? So while there are new, and Phoenix's inventory is dropping each week. So this actually, supply is tightening up, and that actually is that it's like helps to see that perhaps there's a floor for pricing on in Phoenix, because in the supply demand curve, if the quantity of supply starts to fall faster, like that helps put a floor on pricing. Let's look at Orlando. So I mentioned that the Florida markets now are dominating that top 50 list of the big markets with price reductions. And so, here's Orlando, where when Phoenix and Austin were over 60% last year, Orlando was at 50 and now down to 40. And so you can see significantly fewer homes, significantly more homes with price reductions there. So you can see where the softness is in the market. We can see that the inventory in Orlando is actually still significantly fewer than it was in 2019. So this is what I was talking about when Austin is like the one place in the country where we see that inventory greater. Even in Florida, these central Florida markets, which are not moving quickly, they're improved over last fall and starting to move, but the inventory is still sufficiently tight to keep us. It's like buyers don't have a ton of selection. It's not as hard as it was last year, but they don't have a lot of selection. I was on Twitter. I have a friend, Ryan Lundquist, who is a appraiser in Sacramento. Sac Appraiser is his Twitter handle. And Ryan pointed out this week that half of the homes that went into contract in Sacramento this March, so far in March, have been 15 days or less on the market. Half of the homes. Many of those homes, and I mentioned this in our immediate sales data, are going in 0 to 5 days, and like a third of those. And so you can see inventory in Sacramento rose quickly last fall, but now is basically back in pandemic levels of availability. 2,000, it's a third fewer homes on the market in Sacramento right now than there were in 2020, just before the pandemic. And there is 25% fewer, 35% fewer than there were in 2019. There's significantly fewer homes. What you can see in Sacramento is where the demand is. And so Sacramento this is Sacramento Metro, the $1 million homes at 100 days, and anything under 800,000 or so is moving quickly. And so, if you have that buyer seller that says, well, I know that house down the street has been sitting on the market for a long time. You say, yes, but you're buying here at 785. You need to make an offer quickly if you want to get this house. And we can see how quickly those homes are going. That's a dramatic thing. So what we do with these market segments is every Altos market report with this is your branding and your report that you're putting in your client hands. You have the 4 price range segments. So in a given zip code, the high end of the market may be behaving very differently from the low end. And this is how you communicate it. This is how you say, this is our price range that we're shopping in. We're not shopping at $1.5 million. If you had $1.5 million, you could maybe take your time and lowball it. If we find the right house here in your price range, though, we should make the offer now. And obviously that's what's happening, which is why, we can see that half of the homes in Sacramento went in, under 15 days in March. I have a few others here. Let's look at Washington, D.C. real quick. This is price reductions in D.C. So D.C. Metro is basically back in its normal sort of hot market. DC has been a strong housing market for a bunch of years. It's a growth economy. It's a lot of migration, a lot of inbound migration. And so you can see that while price reductions climbed last fall, peaked at 42%, are now back in the 20s, which is just like it normally is. And like normally as price reductions start climbing in the second quarter, because things that didn't sell get listed now, they don't get an offer in March. Now they're sitting in April. By May, they're doing price cuts to try to move. And you can see that normal curve starting to happen there. You can also see a similar price range segment in the expensive ones in the DC area are basically twice as long on the market as anything under 800K. And so you can really see an affordability window there as well. All right, we have a few more open. I'm run up against time. I'm going to stop that the local data here, and just I want you to know that as I've been talking about this data, and we talk about the Altos reports and the importance of you helping your buyers and sellers see what's actually happening right now. They're reading the headlines. They're seeing things and they have expectations about the economy, especially what's going to happen in the future. And so what we're doing right now, and we're saying those things may happen in the future. But if you want to buy a house, here's what we know in the data right now. And we know that inventory is falling each week because there's more buyers than sellers around the country. We know that it's actually inventory remains remarkably restricted, with the exception of maybe Austin, Texas. And even Austin's not a lot. And so when you want to look at your local market, if I didn't get a chance to get to your local markets, go to altosresearch.com. You can book time with our team. You can look at your local market today. You can discuss with our team about how to interpret the data for your local market and get it into your hands of people who might be thinking about buying and selling homes today. And that's what we're here to try to do for you. All right, everybody, that's the time we have for today. I will stick around in the chat. I will keep the chat on for a few more minutes. If you've got last questions, we'll try to answer anything that's lingering there. Thank you as always so much for your time and attention. Look forward to working with you.